Hey everyone, thanks for tuning in to our July 2025 Investment Committee update. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee, along with the group that you see here. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. After initial strong rallies in the markets in late June, following ceasefire agreements between Israel and Iran, global equity markets were mixed during most of July. U.S. stocks did trend slightly higher during the month, with large cap U.S. stocks reaching new highs, and mid cap and small cap stocks exhibiting improving uptrends, while foreign stocks were mostly flat for the month. Overall, stocks globally have been improving since the significant sell-off earlier in the spring, and have been reestablishing new uptrends despite ongoing uncertainty around interest rates, job creation, and global trade. The Big Beautiful Bill was signed into law on July 4th, which does provide some clarity around tax policy going forward. Initial assessments of Q2 GDP in the U.S. came in at a better than expected pace of 3% annualized. However, the labor market is now showing clear signs of contracting, so the outlook for economic growth still remains uncertain. As a result, a tension has formed between President Trump and Fed Reserve Chairman Powell. The Fed continues to hold steady on the Fed funds rate, waiting to see if new tariff policies spark a rise in inflation, while President Trump thinks that current rate policies are holding back the economy. This feud will likely play out over the coming months, but in the meantime, the bond market seems to be sniffing out economic slowing on the horizon, as long-term interest rates have trended mostly lower recently, providing support to bond prices. I will now turn it over to Stephen to walk us through this month's review.
All right, thank you so much, Chad. I appreciate it. As we jump in and we set the scene with a broad perspective of what's going on with the economy. So I'm currently traveling, and the beautiful country that I have the opportunity to come out and see, and seeing some clients along the way, meeting with some other investors and financial advisors. Of course, everybody always wants to know what's next. So we're going to try to do our best to set the stage of where we are right now and where we believe that we're going here. But we're going to begin with a discussion about the Big Beautiful Bill that was signed on the 4th of July this year. It's an 887-page piece of legislation that served by and large to really make the features of the 2017 Tax Cut and Jobs Act permanent. So we're going to record another video in the coming weeks where we go over some of the finer points of that bill that we think are going to be most impactful to our clients. But for today, we're just going to touch on some of the high points, right? And so the first is that there is a new senior deduction of up to $6,000. And I think the purpose around this is really to try to deliver the no tax on Social Security. So that's not a specific piece of the legislation. There isn't anything that says that, but we believe the intention behind this is to really deliver that. So a new senior deduction of up to $6,000, that stacks in addition to the existing senior deduction that's available. Probably one of the bigger deductions or increases to deductions is what happened with state and local tax deductions, the SALT cap, as they refer to it. It was set at $10,000 back in 2017, and that was raised to $40,000. So that is a huge lift, and for individuals in higher tax states, that's a big benefit for them. Another landmark piece of the legislation was the introduction of these Trump accounts, or Section 409A accounts for children that allow for contributions every year of up to $5,000. And for newborns born within specific years, the federal government will actually make a one-time $1,000 a month contribution to those accounts. So something that could pair along with a 529 savings plan for kids. We'll get into some more detail with that later. The last and you know, not to say the most important piece, but the estate exemption that everybody was concerned was, it was due to sunset at the end of this year, and it was going to revert back to around $5 million a piece. Well, it has made the estate exemption permanent on the trajectory that it's on. It's actually increased it to $15 million per person for starting in 2025, and then it'll index for inflation going forward. So big piece of news there. But we'll be back with another video where we uncover some of the finer details on the big beautiful bill. So last month we started the call by saying that the major macro concerns for the market and the economy can really be reduced to jobs, interest rates, and regulation. Well, we got a jobs number for the month of July, and do we notice anything here that the job figures that we got for July were well below expectation? But it wasn't just that those numbers are coming in below expectation, and that's been something that's happening for a number of years now, but the job figures for May and June were revised downwardly in a fairly significant manner. That is nothing new. It's been happening over the last couple of years, but it really calls into question the strength underneath this jobs market. This labor market has really seemed to wane over the last number of years. The labor force participation rate is down at decade level lows, multi-decade level lows, and the number of new entrants into the jobs market has not been robust, and that trend, as we can see, is definitely lower. That's not necessarily an encouraging sign. But let's move on and let's talk about how is the market responding to all this. We're going to start with the S&P 500 index. It's back in an uptrend. It's been in an uptrend now for a few months. It was once down over 20% for the year before Liberation Day, but it's now back and has achieved a new all-time high. It may have been several months since we mentioned this last, but we see the performance of the S&P 500 index returning to a new high. And a lot of that is driven still by very few stocks within the index. And so the U.S. market, particularly these large cap indices, are still heavily weighted and biased to these very large technology companies. NVIDIA, as an example, now has a market capitalization of over $4 trillion. I think Microsoft is probably not very far behind them. And while they may be great industry-leading companies, as we discussed in our latest podcast on artificial intelligence, if you haven't caught that yet, check it out on our YouTube channel. And so these may be great companies, but they're not without competition. And so this chart shows that the percentage that NVIDIA, as an example, represents in the S&P 500 index, it's within 1% of the weighting assigned to the entirety of the industrial and healthcare sectors. Omitted from this particular chart, but the current market cap of the U.S. energy sector is around $3.5 trillion, while the market cap of the U.S. utilities sector is less than $2 trillion. And both of them have already been overtaken in size by NVIDIA alone. And given the energy demands needed to perpetuate the development of artificial intelligence and data centers, that's really a head scratcher. So this seems like something that you see in market manias. So let's move on from the large caps and look at mid caps. And so, as we saw a couple months ago, they've started to resume a new uptrend. So started to resume a new uptrend, although we can see they're still meaningfully underwater relative to their former highs from late last year. And that's something that when you go stock by stock within the market, you see a lot more of that. You don't see new all-time highs for a lot of different names within the market. Same story for small cap stocks. They're back in an uptrend, right, which is great. And they had a meaningful sell-off post Liberation Day, and they're still about 10% below their former highs, but back in an uptrend. But still have a ways to go just to recover back to the level that they had previously achieved post-election last year. Developed international stocks, however, they traded to new all-time highs in mid-July, but they closed the month down almost 2%. Still among the best performing stocks globally so far in 2025. Emerging markets traded up slightly in July, but similar to their developed international counterparts that we just looked at. This index traded to multi-year highs in the middle of the month before pulling back some into the end of the month, right? So emerging markets were given a nice boost over the last couple of months on the back of some successful trade talks developing between the U.S. and China. That deal still remains the largest trade accord that's yet to be solidified. But according to Scott Bessent, the U.S. Treasury Secretary, those discussions continue to make progress, and hopefully a more complete framework can be achieved there in the coming months. As for the bond market, the U.S. aggregate bond index remains in an uptrend, right? So as we discussed earlier, the U.S. employment picture is likely softening sufficiently to provide the Federal Reserve ample room to continue lowering rates at their next meeting in September. And whether it actually exists or not, the perceived rift between President Trump and Fed Chair Powell continues to grow. President Trump continues to press or lobby for lower interest rates, and Chair Powell reiterates that the committee is data dependent and they're attentive to both the labor market and inflation data. Well, inflation has come down materially from where it was 3 years ago, but it remains above the Fed's 2% annualized target rate. So members of the FOMC, the Federal Open Market Committee, that's the group that actually determines and votes on interest rates, they've also stated that they wanted to see if tariffs would translate into higher rates of inflation before agreeing to bring rates down. What we know is that Fed Chair Powell's term, it's up next year. And we suspect that President Trump is going to nominate a replacement for him sometime very soon. One of the people he could nominate, or of the people he could nominate, two of them are already on the Federal Reserve Board of Governors, and both of them are current voters on the FOMC. Ironically, at the Fed's July meeting, where they left interest rates unchanged, these were the two dissents to that policy action. Both people who were presumably vying for the job title of Fed chairman. So they both supported the idea that rates could and should be lowered now. And they believe that the labor market is weakening enough that it's becoming a risk to the overall strength of the U.S. economy. So in the latest turn of events, another existing voting member of the FOMC just resigned, Governor Kugler, effective August the 8th. And so this could pave the way for yet another easy money person to take her seat, which would further placate President Trump's quest for lower interest rates. So all of this to say, the trajectory of bond prices has been higher, which means that the trajectory for interest rates has been lower. Lower rates equals higher bond prices, which is something that we haven't seen much of over the last 5 years. Commodities have really just been moving sideways for the last few months, so not much of a trend here in the commodities index, although we may be seeing some little bottoming formations happening as we retest these 2021 lows here in the commodities index. This Bloomberg Commodities Index, it's very highly leveraged to energy, so crude oil, gasoline, etc. And it had a nice little pop back in June when the tensions with Israel in Iran were at their peak. But as energy prices have settled back down some, that index has subsided a little bit. But commodity prices in general, trendless, maybe trying to find a bottom at the levels that they troughed out at back in 2021. Quick peek at real estate here, also kind of trendless. However, given this asset class's historical sensitivity to interest rates, if we do see interest rates decline, that could be a positive catalyst for this category. All right, so I'm going to hand it back to Chad now for a recap, and then I'm going to leave us with some final thoughts. Chad?
To recap, equity markets were mixed in July, with slight uptrends continuing in U.S. stocks, while foreign stocks were mostly flat. Overall, stocks globally have been improving since the significant sell-off earlier in the spring, and market trends remain largely favorable. The Big Beautiful Bill was signed into law on July 4th and does provide some clarity around tax policy going forward. While recent GDP reports for the U.S. suggest economic expansion is occurring, the outlook for growth is less clear given recent slowing trends in the labor market. Uncertainty around final tariff policies from the U.S. and the near-term direction in the Fed's rate policy is creating a headwind for the markets. Going forward, clarity around trade, leadership of the Federal Reserve, and the potential for further deregulation from the Trump administration could be supportive of the markets. As always, we will utilize our rules-based investment discipline to help us discern market trends that are unfolding rather than attempt to predict any particular outcomes. Stephen, any final thoughts?
All right, thanks so much, everybody, for joining us here again for this month. Hope everybody had a great 4th of July. Hope everybody's having a great summer, and it's time to go back to school. So that's always exciting for everybody. But hope everybody is staying safe out there. Enjoyed your summer, and we've got a lot to look forward to as we head into the fall. As always, if you have any questions, comments, please feel free to reach out to us. We want to do everything we can to make this time as effective for you as possible in terms of giving you the clarity and insight into what is driving the investment process with your money here. So please let us know your feedback. Again, thank you so much for the trust and confidence you continue to place in us here at Reveille, and we will see you again next month. Take care.